Okay, so on August 12th, 2025, Proficient Auto Logistics gave us a classic Wall Street puzzle. The company's stock absolutely soared after an earnings report that, well, if you just glanced at it, looked pretty mixed. So let's break down what really happened. Here's the number that got everyone talking, almost a 24% jump in a single day. This was right after their second quarter earnings call. And listen, this wasn't just some random fluke on low volume. Nope, this was on trading volume that was 5 times the normal average. You know, when you see a move that explosive, you've got to ask, what on earth caused it? And that, right there, is the big mystery we are unpacking today. What did investors see that made them react so bullishly, especially when the main numbers didn't really seem to justify it? All right, let's get into it. We're going to start right where all the confusion began, with those top-line numbers that dropped after the market closed. You know, these are the first things most people see, and honestly, they told 2 completely different stories. This is the whole paradox in a nutshell. On one hand, you've got a really solid revenue beat. Proficient brought in $115.5 million, which easily cleared the $105 million Wall Street was expecting. That was driven by them grabbing more market share. But then you look at the other side and, yikes, a big miss on the bottom line. Their official GAAP earnings came in at a loss of 6 cents per share when the street was looking for a profit of 7 cents. So a beat on top, a miss on the bottom. What gives? Well, here's the crucial point. The market, it basically chose to look right past that earnings miss. Instead, investors focused like a laser on the real story management was telling. And that was a story all about operational execution. This is the slide that really got investors excited. First off, units delivered were up a strong 24% from last year. But check out these profitability numbers. Adjusted operating income more than tripled from the first quarter, jumping from 1.2 million to 3.8 million. And their adjusted operating ratio, which is the key efficiency metric in logistics where lower is always better, it improved by 200 basis points. That's a full 2 percentage points better. This was the proof that the company was getting way more profitable at its core. So management's story on the call was crystal clear. They basically laid out their 4-part game plan, and it was working. They were successfully bringing the new Brothers acquisition into the fold, which helped boost their volume. They were snagging market share, even in a tough auto market. And most importantly, they were seriously controlling costs and making the whole operation more efficient. And this quote from the CEO, man, it just sums up the whole vibe perfectly. He was projecting so much confidence. This told investors that the company was all in on managing its own profitability, no matter what the rest of the market was doing. And that message, it really landed. All right, so that was the good news. But then management started looking forward, and despite that awesome execution in Q2, they set a really cautious, realistic tone for the road ahead, admitting there were some big challenges out there. And here's the number they gave for official guidance: a sequential revenue decline of 2 to 5% for the third quarter. I mean, after celebrating a huge revenue beat, this was a serious dose of reality. It was a signal that the tough environment wasn't just going to disappear. And they were very clear about why. The overall auto market was slowing down. The SAR, that's just the seasonally adjusted annual rate of sales, was hanging out around a pretty soft 15.5 million. Plus, Q3 is just normally a slower season for them. Management was basically saying, look, we're doing great, but we can't completely defy the gravity of a weak economy. So what happened next? Well, the stock's performance since that call tells the rest of the story. You had that initial pop, that massive 24% day of euphoria. But as that macro reality started to sink in over the next couple of months, the stock gave back a big chunk of those gains, pulling back about 17%. The market's excitement got tempered by that cloudy outlook. So when you put it all together, you've got this strong internal execution fighting against a weak external outlook. What's our call on the stock heading into the next earnings report? We have to weigh these 2 competing forces, right? On one side, you have a management team that's proven they can deliver. But on the other, you've got these industry-wide headwinds that are just really tough to fight. So let's break down our thinking. Here's what we think is going to happen next quarter. We're predicting more of the same, really. Management will probably show off more cost controls and efficiency gains. But that top-line revenue growth, it's almost certainly going to be held back by that soft auto market they talked about. So you should expect another report that's focused on defending margins, not on accelerating revenue. So what does that mean for the stock price? Well, we think the stock is probably going to be range-bound, stuck in a sort of tug of war. Any good news on how they're running the business will provide some support, but any bad news about the auto market is going to act like a ceiling. It's a classic battle between a great company story and a tough sector story.
So when you add it all up, our final rating is market perform. Look, the company is executing really well, and management is definitely earned a lot of credibility. But that challenging backdrop for the whole sector, it just prevents us from being more bullish. Until we see some clear signs that the auto market itself is starting to recover, it's just hard to see this stock significantly outperforming.
And of course, we have to end with a crucial reminder for everyone watching. This analysis is for informational purposes only. This is not financial advice.